Hello everyone, welcome. Kay from Up and Away, and today I want to go through part 3 of the Numbers 101 series, which is decoding the balance sheet. Now let me share my screen. Just 1 second. Share screen. And I've got a PowerPoint ready to go. So, by the way, I don't think my four-legged friend in the corner there is in the least bit interested in this session, but I hope you are. So, slideshow from the beginning. So this is all about decoding the balance sheet or understanding a balance sheet. So what does a balance sheet show? And why does it matter? The balance sheet is a snapshot of your business's financial health. It shows what you own, which is called your assets, what you owe, which is called your liabilities, and what you keep, which is your equity. So it helps you understand the stability and sustainability of your business. And it's often used by banks and investors, and of course, by you. So let's have an example. A small plumbing business applies for a business loan. The bank looks at the balance sheet to see if the business has more assets than liabilities, which is called positive equity, and enough cash or receivables to manage the repayments. Now, receivables are the money that your customers owe to you. So without a strong balance sheet, the loan is declined, even if the profit and loss shows a profit. So that shows you how important your balance sheet is. It's not just your profit and loss. So assets, liabilities, and equity explained simply. So assets, it's what you own. So you might have equipment, it might be money owing to you, it might be cash at bank. Or it could also be inventory. So if it's non-current, it's more likely to be the equipment because it's something that will last for several years. Current is stuff that will turn over quite quickly. So non-current again could be equipment, property, or even websites. So the liabilities is what you owe to people. So the current liabilities would be bills that you owe to suppliers. It could be wages you owe to staff. It could be GST, superannuation, short-term loans. And non-current liabilities would be long-term loans. So if you've got a loan for several years, it would go into your long-term liabilities. Equity is the assets minus the liabilities. So it's what's left over for you. So an example, a tradie owns a ute worth $30,000 and has $5,000 in tools, which are assets. He owes $10,000 on the ute loan and $2,000 in unpaid supply bills, which is his liabilities. His equity is the $35,000, which is the ute and the tools, minus $12,000, which is the 10 and the 2, which is his liabilities. So that's $23,000. This means the business is in a strong position. He owns more than he owes. So how to spot financial red flags? So if you've got low or negative equity, which means more debt than assets, so you owe more than you own. High debt levels, it's risky. If your income drops, it means you won't be able to pay back those loans. And slow paying customers, which means high receivables, so money that isn't coming in. So low cash, trouble paying bills is a red flag, and inventory buildup, which means that your cash is tied up in inventory. So all of these are red flags that you should watch out for. An example, florist builds up too much stock before Valentine's Day, but sales are lower than expected. She's left with $15,000 in unsold inventory. She's tied up in cash. So $2,000 in the bank, but owes $10,000 in supplier bills. Her working capital is stretched. So see the next slide. She struggles to pay her BAS on time. So that $15,000 she could really do with in cash, but she's tied it up in inventory that she hasn't sold. She's only got $2,000 in the bank, so she can't pay the $10,000. So supplier bills at the moment, and she will not be able to pay her BAS on time. So what is working capital? A simple definition is working capital is the money your business has available to run day-to-day operations. So how it's calculated, it's what you own, like cash and money owed to you, minus what you owe, like bills and short-term loans. So why does it matter? It shows if your business can pay its bills on time. It helps keep your operations running smoothly. A good indicator of your short-term financial health. So it's a good indicator of how healthy your company is in the short term. A quick tip, if your working capital is positive, you're likely in good shape. If it's negative, you may need to take action. So these are the KPIs, as we call them, key performance indicators, that you can set to look at to see how your business is doing. And it's very important to do that and not just look at profit and loss. So working capital basics. Working capital is current assets minus current liabilities. If it's positive, it means good short-term financial health. If it's negative, there's a risk of you missing payments. As an example, current assets of $30,000, current liabilities of $20,000. Working capital is $10,000, which is a healthy position. Another example, a cafe has cash of $5,000, inventory of $10,000, accounts receivable of $2,000, accounts payable of $12,000. Working capital is $17,000, which is cash, inventory, and accounts receivable, minus the $12,000 accounts payable. That's $5,000. It's a positive figure, which shows that the cafe can comfortably cover short-term bills. That's good. So how the balance sheet and profit and loss tie in together, a lot of people wouldn't understand this. So profit increases equity on the balance sheet. So if you've got a profit, that's where it goes on your balance sheet. If you've got unpaid invoices, it's accounts receivable on the balance sheet. Entered but unpaid bills is liabilities. So that's what you owe to your suppliers, etc. And the profit and loss is performance over time. Shows how your business is performing as far as sales, expenses, net profit is concerned. The balance sheet shows your current financial standing. It's a point in time. An example, a web designer bills $3,000 for a project in June, which is recorded in the profit and loss as income, but the client doesn't pay until July. The June profit and loss shows profit, but the balance sheet in June shows $3,000 in accounts receivable, meaning the cash hasn't yet hit the bank. So let's take a look at what a balance sheet looks like. This is taken, it's just an example, it's not taken from anywhere. So if you're actually looking at a balance sheet, this is what it would look like. So you've got your current assets, cash, accounts receivable, inventory, prepaid expenses, you may have prepaid some things, fixed assets and non-current assets, which is your equipment, motor vehicles, property, less any depreciation on those assets, gives you your current assets. Actually, that's not quite right on here. So non-current assets is 40,000. So that's your 50 minus your 10. Current assets is 55, which is 25 plus 12 plus 15 plus 3. This looks a bit odd on this example. Non-current assets, we've got liabilities, accounts payable, what you owe your suppliers, credit cards. wages payable, and then non-current liabilities, any loans that you have. So you've got current liabilities 14,500, which is 8,425. Non-current is the 20,000. Equity might be some capital you've paid in to start the business, and retained earnings is your profits over time. So the accumulated profits. So total assets is 95,000, liabilities 34.5, equity 65,000. So that is what a balance sheet looks like. I don't expect you to understand this fully, but I'm hoping this is giving you a grounding so that you can understand it is something that you need to look at and check. And if you need any help, reach out to me. I'm more than happy to answer any questions that you may have. So thank you very much for listening, and enjoy the rest of your day. You stop sharing and say goodbye. And I told you that this would be totally boring for my friend in the corner over there.